Hi everyone, and welcome again to Nettle, the go-to place to learn about business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and I also greatly appreciate if you consider supporting us as well. So touch the link in the description and click the join button below for more details. My name is Sava, and today we're going to investigate the credit risk framework for Basel III on an example of the annual report of the Royal Bank of Scotland in 2008. The selection is quite interesting in the sense that Royal Bank of Scotland has famously performed quite poorly during the global financial crisis of 2007-2009, and what is more importantly, back in the day, Basel III revisions to credit risk were not yet implemented. So we can use the guidelines provided by the Basel Committee for Banking Supervision in terms of how to account for credit risk, in particular how to calculate credit risk-weighted assets that are then used in calculations of Tier 1 capital ratio, for example, using the Basel III methodology and the data that has been provided by Royal Bank of Scotland in 2009, and compare it with the reported risk-weighted assets to see whether the degree of credit riskiness of Royal Bank of Scotland, as measured by Basel III, is higher than what they measured back in the day using still the Basel II logic. And the main data set that we have extracted from the Royal Bank of Scotland 2008 annual report is the breakdown of the main asset groups as well as some notable off-balance sheet items throughout the AQ groups. So we can see here AQ1, AQ2, AQ3 up to AQ5, and those stand for asset quality groups that banks assign to their assets in terms of their credit risk level. And for most of the asset groups, these quite neatly correspond to credit ratings. For example, as Royal Bank of Scotland themselves suggest, those correspond to 5 credit rating buckets that are very commonly used when evaluating the level of credit risk for, say, sovereign debt, corporate debt, or even something like corporate loans. So, for example, asset quality bucket 1 would be AAA to AA- rated obligors, whereas asset quality 5 would be those with a heavily speculative rating, say below B-. And that quite nicely corresponds to the risk weight guidelines provided by the Basel Committee for Banking Supervision, in particular in their credit risk document CRE 20, which would allow us to adjust the assets reported by Royal Bank of Scotland into risk-weighted assets using those conversion weights. In terms of other groups, we have got assets that are past due, non-accruing, and the provisions for those. So essentially, those are non-performing assets or poorly performing assets that need to be accounted for specifically when figuring out the level of risk-weighted assets. Here, we have got a range of asset groups that would allow us to quite nicely account for a number of different types of assets in terms of their credit risk and go through some of the interesting measures and provisions that Basel III has. So we have got here cash and balances at central banks, loans and advances to banks and customers, which are treated very differently under many risk guidelines of Basel III, mainly liquidity risk, but credit risk as well. Debt securities, so bonds that Royal Bank of Scotland holds of other corporations and sovereigns. Settlement balances, which basically are balances due to be settled, so essentially it's cash on its way. Derivatives exposures that have a particular treatment in Basel III credit risk calculations. Other assets, which if we carefully study what Royal Bank of Scotland means by other financial instruments, those would mainly be exposures to unlisted equity, so say small stakes that Royal Bank of Scotland might have in some companies. So those have their own special treatment in Basel III credit risk. And we have got off-balance sheet items such as commitments and contingent liabilities, which have credit conversion factors in Basel III. So let's first start by trying to figure out how to spread, let's say, debt securities into sovereign debt securities and corporate debt securities, because those have different risk weights as per the Basel III guidelines. So here we have got exposure to sovereign debt, which are basically government bonds, and we can see that very high quality government debt actually is not risk weighted at all. If you have got, let's say, US government bonds, they're deemed credit risk free for the same reasons as, let's say, in stock market finance, we deem the yield on US government bonds as a risk-free rate or risk-free rate of return, because again, very credit-worthy, very well-established economies are unlikely to default. But here we see that if we're investing in a high-quality non-financial corporation, say buying their bond, they have got a positive risk weight here. But as we move on to more speculative grades, it's essentially the same risk weight for sovereigns and for corporates. In the Royal Bank of Scotland report, we can see that the total amount of sovereign debt securities that Royal Bank of Scotland holds is 102.293 million pounds. So essentially, we can figure out the ratio by looking at total number of debt securities from their asset quality analysis, and figure out the percentage of sovereign debt by dividing the sovereign debt securities onto total debt securities. And that would allow us to figure out the structure of debt securities between sovereign and corporate. For that, we need to multiply in each asset quality group the amount of debt securities by first the percentage of sovereign debt securities and by the percentage of corporate, so 1 minus the percentage of sovereign. And then we drag it across all 5 asset quality groups. We do not need to worry about the non-performing asset just now, simply because those will be treated separately towards the end of our calculation. Now, if we want to treat the commitments and contingent liabilities here, we need to keep track of their credit conversion factors. And as per Basel III, and in particular the CRE 20 document, commitments are converted into credit equivalent with a ratio of 100%. So basically treated as risky as just conventional assets, conventional loans that the bank issues, for example. And contingent liabilities are treated with a lower credit conversion factor of 50% in general. So let's convert them into loans and advances to customer equivalents, essentially, for the purposes of credit risk-weighted assets calculations, by adding commitments times 100% and contingent liabilities times 50%. And again, across all 5 asset quality groups. Now, customers is a very broad term, and it can include individuals, let's say household loans or credit card debt, auto loans, student loans. It can include mortgages, which are treated very differently for credit risk purposes, as they are backed by residential property. And finally, it can also include corporate loans that will be treated very similarly to corporate debt securities from the purposes of credit risk weighting. To study that, we can see exposures to residential real estate or to mortgages would depend on their asset quality, but this asset quality has nothing to do with the credit rating, because essentially you cannot rate a particular mortgage that would be too cumbersome. But what those groups are instead are loan-to-value ratios, because if loan-to-value ratio is low, say the property is valued at a very high level compared to the amount of outstanding loan, then it's quite easy to recoup any potential losses from a default or a delay in payment of the mortgage, if the bank reappropriates the property back. But if the loan-to-value ratio is high, and especially if there is, say, a recession and the house prices drop, the bank might actually not recover a large proportion of the value of the loan if it defaults. So here we use those bands and those risk weights as our asset quality proxies when we're talking about exposures to mortgages. There is, again, a notion of retail exposure and regulatory versus other retail exposure. Those are generally loans to individuals, households, and the difference between regulatory and other, it mainly has to do with the size of the customer. And in general, the Basel Committee for Banking Supervision has two main guidelines. So if the total exposure of a bank to a particular individual is greater than 0.2% of the bank, then this cannot be deemed regulatory and it has to be weighted with a high weight because this individual is very large, very material to the bank. So those would be like high net worth individuals, very prominent clients of a bank. And also if a particular exposure to a particular individual is greater than 1 million euros, Basel Committee for Banking Supervision deems that to be riskier and therefore cannot be considered a regulatory retail exposure with 75% weight. But here, let's keep things simple and treat all of our exposure to individuals as regulatory, because again, these sorts of customers are quite rare. And finally, exposure to non-financial corporation is something we have already discussed when calculating the exposures to corporate debt securities. So how to actually break this down? Well, what Royal Bank of Scotland reports as well is the structure of loans and advances to customers in the UK. And we can impose the structure that they've got in the UK on the group data. Obviously it would be imperfect, but that's something that you have always to keep in mind when analyzing bank data as an outsider, as an outside analyst, simply because the granularity and the quality of the data that's available to you is obviously lower than the one that's available to a bank insider. And that means that always you have to use proxies, you have to use assumptions when trying to calculate some of those ratios or some of those metrics for a bank, and there is nothing wrong about it. We don't need to be afraid to make assumptions and use proxies when analyzing bank data as an outside analyst. So here we can calculate the percentages of, say, mortgages within total loans and advances to customers and apply it throughout. And here we see that those do add up to 100%, and we have got a nice correspondence. Mortgages would be the proportion of loans and advances to customers that are classified as exposure to real estate. Personal and cards would be exposure to individuals, and business would be exposure to corporates. So here, exposure to real estate would be loans and advances to customers times the percentage of mortgages. Exposures to individuals would be loans and advances to customers, again, with commitments and contingent liabilities converted and included there, times the sum of the personal and the cards components. And exposure to corporates, loans and advances to customers times the percentage of business loans plus corporate debt securities, as that also constitutes exposure to corporates or non-financial corporations. When we talk about exposure to banks, we have to treat it differently. And here, the main reason for it is that we have got different weights for long-term and short-term exposures. Short-term is defined for this particular purpose as 3 months or shorter, and therefore we need to know how much of those loans and advances to banks falls below 3 months. And Royal Bank of Scotland does report it in another part of their disclosure, so not in their asset quality analysis, but in their maturity analysis. So we can figure out that among the total loans and advances to banks, 61 1,630 million is short term. So we can refer to the total amount and figure out the percentage of short term loans and advances to banks. And now obviously we have got to assume that short term and long term loans and advances to banks are uniformly spread across asset quality groups. So short term and long term are the same in terms of their asset quality. Again, it's an assumption that needs to be made. It is relatively reasonable, and therefore we'll stick with that. So for splitting the exposure to banks to long term and short term, we can multiply the total loans and advances to banks by 1 minus the percentage of short term and by the percentage of short term itself. Now we can drag it across all 5 asset quality groups, and that mostly concludes the structural preparations for our calculation of risk-weighted assets and the Tier 1 capital ratio. So here we can already calculate the risk-weighted assets of sovereign debt. For that, we need to use the sum product function, refer to sovereign debt securities, and to risk weights of sovereign debt across asset quality groups, or across credit rating groups in this case. And we see that the risk-weighted assets for sovereign debt is 2,764 million. For real estate, we do the same, sum product of exposures to real estate, and then cross multiplied by risk weights across asset quality groups for exposure to real estate. Obviously, if we're talking about real estate exposures, there are also commercial real estate, but here it's not necessarily easily identifiable, and that would mostly be classed under the exposure to corporates. And ultimately, in most cases, it is classified either with the same risk weight as the risk weight of the corporate or at a lower weight. So essentially, here we're treating it conservatively. Now we can calculate the risk-weighted assets for individuals. So sum product, exposure to individuals. So for that, as we do not have asset quality groups respective weights for individuals, we can just sum up those exposures and multiply them by 75%, as we have previously assumed that pretty much all of those exposures can be classed as regulatory due to very high net worth individuals being quite uncommon. For corporates, we can use sum product again and refer to exposures to corporates from above and non-financial corporation exposure risk weights. For banks, we again need to keep in mind short-term and long-term exposure differences and the risk weights provided for base risk weights and short-term exposure risk weights. For derivatives, we have to use a risk weight of 4%. Again, it's either 2% or 4% depending on clearing, but let's be conservative and say 4%. So we need to sum derivatives across 5 asset quality groups and times it by 4%. For settlement balances, we need to figure out the cash and process of collection risk weight, which is 20%, because it's almost cash but not yet there. So essentially we need to sum settlement balances across 5 groups, times it by 20%, the cash and process of collection risk weight. For other assets, we need context, again, that most of those other assets are unlisted equities. Equities have got very high risk weights under Basel III credit risk, and here we've got a distinction between listed equity and unlisted equity. Unlisted equity has a risk weight of 400% compared to 250% for listed equity, so we'll use 400% here. So we'll multiply the total of other assets across, again, all 5 quality groups times the 400% risk weight. We did not include cash and balance in central banks because those have got a risk weight of 0% and they do not need to be included. And finally, we need to address non-performing assets. So essentially those three columns, those that are past due, non-accruing, and the provisions for those non-performing assets. Here, the baseline risk weight is 100%, but it can be as high as 150% if there are few provisions for those non-performing assets. But let's use just 100% for this particular case. So let's do the sum of those three columns times the factor of 100% again, and we will calculate net of provisions because we'll subtract the provisions automatically. And now we can figure out total risk-weighted assets for credit risk by summing up all of those categories. We arrive at a figure of 662,793, which is notably higher than the amount reported by Royal Bank of Scotland in 2008. And it's 20% higher, approximately. Obviously, that would also affect quite materially the calculation of our Tier 1 capital ratio, because what they reported is a Tier 1 capital ratio of 10%. This takes into account not only the credit risk-weighted assets, but also ones for counterparty risk, market risk, and operational risk. But we can see that those represent only a fraction of the credit risk-weighted assets, and again, that's still quite common for banks with traditional business models to have credit risk as their main component when risk-weighted assets are concerned. So let's calculate our Tier 1 capital ratio when we readjust our credit risk-weighted asset calculation to Basel III methodology. Again, we use proxies along the way, and we made some assumptions, but we arrived at the figure that's of the same order of magnitude than the figure that was reported, and it's roughly 20% higher. That essentially tells us that the guidelines have become a little bit more strict after the implementation of Basel III. So let's divide Tier 1 capital reported by Royal Bank of Scotland by the sum of our calculated risk-weighted assets and the reported figures for the other types of risk-weighted assets. And that results in a much lower Tier 1 capital ratio of 8.65%, but it's still above the mandated requirements. So even after we adjust the credit risk-weighted assets of Royal Bank of Scotland during the global financial crisis by the new Basel III requirements, we still have got a reasonable Tier 1 capital ratio, albeit it's slightly lower, sizably lower in fact, than the one that they reported at the time. And that's all there is for the calculation of credit risk-weighted assets according to Basel III methodology, and some useful tips about how to work with bank data as well as Basel standards as an outside analyst and make sense of them. Please leave a like on this video if you found it helpful. In the comments below, make any further suggestions for videos you would like me to record, and please don't forget to subscribe to our channel and consider support on Patreon. Thank you very much, and stay tuned.